if you're an active investor, you can really benefit from these shorter cycles. The value of every business, the value of a farm, the value of an apartment, the value of any economic asset is 100% sensitive to interest rates. From last couple of weeks, I have been, talking about rates, the impact of it on the stock market, why I believe that for next year and a half, you may not see like a complete recovery. You may see lot of pullbacks. You may see lot of recoveries for shorter cycles. So you have to focus on these shorter cycles. So if you're like a trader, if you're an active investor, you can really benefit from these shorter cycles, but you have to be very, very careful. So now let's see what this guy, the David Tepper, so he's a hedge fund billionaire, and what he is saying. So he expects stock valuations to fall due to interest rate and quantitative tightening. So again, the same story. So interest rates are going up. Fed is trying to tackle the inflation. Then interest rates are going up, and because of that, and they are doing quantitative tightening. They are kind of trying to shrink their books so that inflation can be tamed. Now this is what he thinks, that financial conditions have worsened. That's true. So valuations must drop too. So it is an impact. This is like a consequence of your financial conditions get worsen. The valuation definitely is going to get impacted. You are not going to see the same multiple that you saw in 2021, but there are certain exceptions. So there are exceptions like Tesla, there are exceptions like Nvidia, and some of the companies which leverage AI. You are seeing the valuations going up for those companies at least, but overall, if you're looking at the market overall, the valuations are dropping, right? And again, the Fed's rate hikes and efforts to cut its balance sheet mark a new era for market, Tapper says. Again, true. So it's not just David Tapper, right, which believes that interest rate has an impact on stock market. Warren Buffett, right? So back in 2013, he said that interest rates are to prices like gravity is to Apple. Apple falls down, right? If interest rates go up, they are going to drag the stocks down. The value of every business, the value of a farm, the value of an apartment, the value of any economic asset is 100% sensitive to interest rates, which is true. We are seeing lot of challenges right now. The housing is getting impacted as we speak. So we are going to see that. Let's see what David Tepper is up to. So he revealed that he recently parked some of the cash in a 6-month certificate of deposit, which is paying 6%. I think this is probably a brilliant move. You can stay in cash, like when things are kind of bad, in my opinion, right? Few options are there. You stay in cash, right? Or you go into an asset which is, some he is putting his cash, some of his cash in these CDs, paying 6%. I think this is a brilliant move from his side. And if I look at how the sectors are doing, I pulled the outlier dashboard, right? So this year is one of those years where you saw probably quite few downside indicators active on our dashboard. So right now, discretionary, it's active for discretionary sector. No second guesses there, because there's a UAV strike, and all of these companies, they are into discretionary, industrial, Then you are seeing on financial sector is impacted, materials, real estate staple. So right now, you know, I'll just stay away from these sectors. In fact, I'll just, if I can, I'll stay away from the market altogether for some time until we see a recovery, or at least if you are an active investor, you see this, you can identify the tail end of this down cycle for this smaller cycle. So again, thanks for watching, and I will see you in few days.